welcome to the business edition of PM Express. My name is Philip Nanfuri. Last week, Friday, on the 31st of May 2019, the Bank of Ghana decided on a Friday to revoke some licenses of a number of microfinance and microcredit institutions in the country. Now, I must say, this action on a Friday, I considered it untenable, simply for the fact that Friday is a day for winding down. But that notwithstanding, the Bank of Ghana decided to go ahead and close a number of microfinance and microcredit institutions. Now, on tonight's show, we want to examine a number of issues. The importance of microfinance globally and in Ghana, where it all began, what the possible causes of the problems are, and the way forward for that. We've put together a number of infographics to educate you, the viewers and the listeners, on what exactly is going on in the microfinance industry. But first of all, let's understand where microfinance began. It started in 1976 with Professor Mohammed Yunus. He's normally called the father of modern-day microfinance. Since then, it has transformed, it has improved to what we have today, and in our part of the world, that's Ghana, we have a number of microfinance institutions. With the causes, the Bank of Ghana says corporate governance featured again. Some of these institutions had unsustainable rates that led to high cost of operations, amongst other reasons. Are there any other reasons? We'll find out. But what's the way forward for the industry? Should we expect the closure of some more microfinance institutions, or should we expect the number at 168 to remain the same? Your guess is as good as mine. But on tonight's show, we want to explore these. We've spoken to the experts, we've spoken to the Bank of Ghana, but we want to add one more person to the show, somebody who has lost his microfinance institution. His license is no longer in existence. He'll be telling us his story of where it all began and where it possibly went wrong. So expect more on this action-packed edition of PM Express, the business edition, with me, Philip Nanfuri, and my guests. So join us as we head into the studio for our discussion. And just as I promised, we are back in the studio. My name is Philip Nanfuri, and this is the business edition of PM Express. I'll just cut straight to my guest. First guest, Nkunim Asante Entry. He's the director for Yield Rock Services. And the man I spoke about, the one who has lost his microfinance company and who disagrees vehemently with the Bank of Ghana, his name Yekson Emmanuel Kugbulenu. His microfinance was formerly called Yekin Microfinance, and he's going to tell us his story. So these are the gentlemen joining me in the studio. But before we do the discussions, let's listen to the Bank of Ghana's representative on microfinance issues. His name, Joseph Amwa Ewa. He is the head of other financial institutions supervision at the Bank of Ghana. Listen to what he says.
We have engaged them. Majority of them, don't forget, the majority of them were in operation. A good number are ceased operation. So getting them around the table, giving them instructions and so on. I can tell you that every time we've done our work, we've written to them. Every time we have done on-site exam, we are giving them report. So based on what we find that's wrong with the institution, we are able to communicate these things to them. So these are things that are known to them. These are things that we have documented them, we have them on record, and we're able to call all the way to encouraging them, look for partners, find fresh capital, make these injections, or partner with others, get acquired by stronger institutions. We're not too successful. We have very few institutions that were able to do this, and so on and so forth. But largely, given the model that they operate in, private limited liability companies, very small institutions all over the map, it became difficult for us to get all of them. But through our off-site and on-site engagements, I can tell you that we are being through all of them, and we have engaged all of them. We've been in contact with all of them, and we've been having conversations.
So that was Joseph Amwewa. He's the head of other financial institutions supervision at the Bank of Ghana. And my colleague Eben Sabuti had an interaction with him somewhere on Tuesday, and he was sharing the exact reasons that the Bank of Ghana advanced in its press release on Friday, 31st of May. Now I want us to move on to the conversation. My guest again, Nkunim Asante Entry, he's the director for Yield Rock Services, Microcredit, and Yekson Emmanuel Kugbulenu. He's an affected individual. He's lost his microfinance license. His company is no longer in existence. Prior to this, his institution name was Yekin Microfinance, and he's going to tell us a bit of his story. I know telling his whole story would keep us here beyond 12 a.m., I must imagine, but he's going to put it in perspective for us, and we'll hear from him. We've heard from experts, we've heard from Bank of Ghana. Let's speak to exactly somebody who has owned this institution and hear from them. We also hear from market women or traders as we go along in the show, and how exactly they see this whole conundrum or debacle, because they're the ones who literally borrow from these institutions. Microfinance serves the lower end of the market. So I'm going to talk to Nkunim first. And I'm sure last week Friday, even though I work in the media, I was as shocked as some of our brothers and sisters outside were. What was your reaction when the Bank of Ghana dropped this bomb on us on Friday, last week Friday?
Well, first of all, thanks for having me. It's great to be here. And I also want to do a very quick disclaimer. Yield Rock is part of Microcredit Association Ghana, but I'm here wearing the cap of an analyst,
okay,
not necessarily representing the views of Microcredit Association Ghana. So I want that to be clear.
Well noted.
Right. So, well, these are interesting times. Last Friday we all heard the news, and our initial reaction was like, oh, because when it started in the banking sector, we were all expecting things to cascade down to the lower tiers, but we didn't know how exactly the shape and form it was going to take. So the news came with a shock, but when you examine things broadly from a more higher perspective, there are people take issues with the process that was taken. But in terms of the substance, I think there's a case to be made for the fact that in the final analysis, it will inject confidence into the financial markets. That's a view that I hold. If you have an opportunity to read the Global Financial Index by the World Bank, the 2017 data specifically, the percentage of population above 15 years I took a look at about 6 countries in sub-Saharan Africa, percentage of population about 15 years. We didn't have an account with financial institutions because they didn't have trust in the financial institutions. In Ghana, the rate was about 16.7%. In South Africa, it was about 26.65%. Nigeria was about 4.95%. Now, if you recollect very clearly, there was one governor, Sanusi Lamido, if you recall.
Very, very popular
Exactly.
governor of the...
Same model of cleanup, you know, but eventually confidence built up in the Nigerian financial market. So our hope and our expectation that eventually confidence will come back into the financial market because there are issues. I mean, there are issues in the financial markets that we need to address as protectionists. BOG, my view is that culpability goes around the table. The regulator, the market participants, even the customers themselves. Because all of the issues that they raised, I mean, there were 2 broad themes that they pointed out. Regulatory violations and supervisory concerns. Then they broke it down into something about poor risk management, poor lending practices, poor corporate governance, and so on and so on. I'll take my time to go through one by one, but I want to look at a very broad framework. The regulatory approach or the regulatory concerns of the regulator falls into what I call the PTA framework: prudential thresholds, transaction limits, and asset liability structures. When it comes to prudential thresholds, the regulator is particularly interested in, especially with the deposit-taking microfinance institutions. They're interested in your capital adequacy ratio, which is Rule 33.1, interested in your liquidity reserve requirements, primary reserve requirements, secondary reserve requirements, and in some cases, special reserve requirements. They're also interested in the gearing. A lot of people don't realize that the regulator is very particular about how much leverage you can take on your balance sheet as an MFI.
Breaking down leverage for the ordinary man, how much debt they can hold.
How much debt, yes. So in our sector, Rule 33.2 specifies that in our sector, for every 1 CD of equity you can have more than 8 CDs of debt.
Okay. So of borrowing. Of
borrowing, exactly. So if you have 100,000 CDs in equity, the maximum amount of borrowing you can do is 800,000 CDs. So these are some of the concerns that, in my view, I think they categorize under regulatory violations. What we don't have is the specifics. All of the licenses that has been revoked, the specific things that they violated, we don't have that information. So it makes it difficult from an analytic perspective to zoom in and say, okay, A, B, C, and D were the things that were wrong. That's the difficulty that we have right now. So now all we can do is just generalize. Looking within the context of the law and the legal framework, we can generalize, but we can't specify that microfinance A was guilty of A, B, C, and D. I'm sure maybe with time, because if you realize in the banking sector, information flow was slow, but eventually more specifics came. So there was information about what Heritage Bank did, about what Premium Bank did, and so on and so forth. My expectation is that going forward, the BOG will provide those further particulars in terms of some of the specific violations. I think it's also good in terms for learning purposes, because I mean, these things are not new. A lot of people didn't even know that in 2015, under Governor Wampa, there were 70 microfinance organizations whose provisional licenses were revoked. People don't know that. 2013, 50 microfinance organizations collapsed. So the microfinance sector has infamy for all of these egregious violations that has been talked about: poor lending practices, poor risk management, poor corporate governance, and so on and so forth. So that will be my introductory comment. I want to zoom in specifically on the lending practices, poor risk management, because there are issues that, as far as I'm concerned, both market participants, the customer demographics that the MFI serve, and the regulator itself, I think ought to take some culpability for. We need to examine those things in all honesty so we can move forward.
Okay, we would delve into the causes and then, most importantly, the solutions to the current crisis. But coming to Jackson, last week Friday, when your institution, together with 385 others, were collapsed or had their licenses revoked. I got to hear the news from Bank of Ghana's website, and we had more discussions in here. Were you told about the revocation of your license?
Yes, thank you very much, Philip. It is a very great opportunity this evening to be with you. And also, I extend my greetings to the viewers all over the world that is looking at us here. In actual fact, indeed, I personally did not see my name on the net or anywhere, but one of my directors called me and to tell me that this is what has really happened. So that very day, in fact, it was one of the joyous days for me. I slept more than any other days.
Why will you say that?
Yes, because I can tell you for the fact that since 2008, when I conducted my market research, realized that the poor have been deprived for credit facilities, and their businesses have been suffering day and night. And then I decided to engage myself by assisting these poor market women and men. I've never had a rest till 31st of May 2019.
Last week.
I really thank my soul, and I slept and slept well. Why am I saying this? Although we are a microfinance institution, some of us have a way of operating the industry. We don't just follow the crowd, because we use our past to guide ourselves, and also the future as well. So we, be the directors of Yeken Microfinance, we have made it clear in our policies that we will not accept any deposits from anywhere.
So then, if you're not going to accept deposits, how are you going to fund, or how are you funding your institution? That's a very critical question.
Yes, it is a very critical question, because I can tell you for the fact that we don't just engage directors in our institution without an equity. Each and every director that comes to the board must make sure he brings something to the board. I can tell you the fact that one of my directors, who is a lecturer, from the inception of this company up to date, he has never taken even a salary, but he brings money on board. I can tell you the third person, who is a lady in our midst as a director, worked with institutions for 14 good years, and all her entitlements, salary, whatever that she, being a proceed from her hard work, was brought to on board. Myself, the genesis of Yeken Microfinance is basically on transport. I started my company, this company, with 3,000 Ghana cedis. I used 1,200 to rent an office, and I used 1,800 cedis to begin the business.
To just 3,000 Ghana cedis. And
yes.
That was in what year? 2008?
2008.
So that was prior to Bank of Ghana's formalization of the sector in 2011,
right.
If
Yes.
I'm right. Okay. Jackson, in 2018, March, there was a press release or a notice from the Bank of Ghana. It was signed by Mrs. Caroline Otu, former secretary of the Bank of Ghana. And then I went through that list. I'll put the list up for us later on in the show. And your name was there as a microfinance institution, Tier 2, in good standing, operating from the Greater Accra region, right?
That's correct.
From that time till today, May, that's a period of 1 year and maybe 2 months. What went wrong in your institution? And why has your license been revoked today? Because if last year you were in good standing, what might have drastically changed over a course of 1 year to warrant a revocation of your license?
Yes, considering the question that you put before me, I cannot tell you as a fact that this is the basis upon which my license or our license is revoked. as I speak to you now. I've not received any letter from the BOG stating categorically that my license is revoked. And we believe that we are on course. For the fact that we did not meet a minimum capital of 2 million Ghana cedis, we don't have any liability that to push us out of the business at all. We are still strong. The least we have, we manage it. And very unfortunately, on the 31st of May, our name popped up. I can remember that on the 24th of April, examiners came to my institutions and to conduct their on-site examination.
And then, do you have documentation to back this? You have documentation to back this date that you say the regulator came?
Yes. It is also in the report.
Okay.
So when they came, they conducted the examination. In the process, there's some unupdated issues with the system. So they told us they can go, and later we can also rectify it. And on the 20th of May, a report was ready to us. And then when a report was given to us, among many other things, it was addressed that one, we shouldn't take a deposit.
Okay.
Meanwhile, we do not engage in deposit taking. And then the final one was that we should address certain issues before 31st of July 2000.
What are some of these issues, Jackson? If you say address issues, what are some of these issues the regulator asked you to address?
They mentioned that we should address issue concerning the
Liquidity.
the liquidity.
Okay.
That is one. Meanwhile, we claim that, well, we don't take a deposit and to be under pressure to pay anybody.
Okay.
And then they have recommended that we should not open any additional branch of the institutions any longer. And then the directors also should, salary should be, suspended for some time and for further notice. These are the things that I can now remember and to tell you now. So we were given up to 31st of July to put our house in order.
Okay.
So we were waiting to see what we can do together, then to see how best that we can address the issue before the BOG. And then to our surprise, the 31st of July has not come, and our name is among the insolvent institutions.
Okay. You mentioned insolvents because your company, Yakin, was part of the institutions that Bank of Ghana says were insolvent. Bank of Ghana had categorized institutions, as we're all aware, into those that were insolvent and those that were insolvent and had ceased operations. From a layman's perspective, and from all the banking sector blues, we have come to understand insolvent as you cannot mature your long-term liabilities any longer. As at the time you took this report, Bank of Ghana had agreed that all of you meet a minimum capital requirement of 2 million Ghana cedis. Is that right?
Yeah, that's correct.
As at the time you received this report, had you met their 2 million Ghana cedis minimum capital requirements? What was the engagement you had with the regulator on that?
Oh, there's we were asked to present our capital plan and to meet such a minimum capital requirements. That was as far back as 2000 and I think 17, if I'm yeah. So we have presented us to BOG, and then also we directors have also passed our resolution, which is something that we are working towards seriously before this news pop up. Yes, but in order not to say anything here, we are not insolvent because we did not meet a minimum capital requirement. No. You know, once our name has been declared over there, some of us are just waiting and to see how many people, customers, depositors will go to Microfinance with their passbooks, deposits, whatever form they name it, and to demand for their money. That's what I'm waiting for. And since Monday, I was sitting in my office waiting for any of them to show up.
Though your license has been revoked?
Yes, I'm sitting in the office because I can't.
Aren't you flouting any regulations? Because Bank of Ghana says you are no longer in existence. How do you sit in your office then?
Yes, I cannot just close the institution just like that. If in event the receiver comes and demand the keys from me, then I'll hand over the institutions to him. I cannot also just abandon the office and go. No, that, and more so, Bank of Ghana did not give rights to me vacate your office, upon which I'll act on that order. So we are just waiting to see
what will happen.
Yeah, what will happen.
Okay, this is the business edition of PM Express. My name is Philip Nanfuri. My guest, the one you just heard, Yekson Emmanuel Kublenu. He's the owner of a defunct microfinance institution, and Nkunim Asante Entry, Director, Yield Rock Microcredit Services. We're taking a quick break. We'll be right back. Thanks for staying with us. This is the business edition of PM Express. My name is Philip Nanfuri. Before we went on the break, my guest was just taking us through his very personal story of how it started for him. 3,000 Ghana cedis was what led him to start his own microfinance institution. Today, as he sits here, he no longer owns his own institution. Why is that so? He was taking us through some of the reasons, what he feels has gone wrong. But I want to bring in Nkunim here. He's going to tell us, to give us some flesh to some of the reasons adduced by Yekson for his current problems. Nkunim, you've heard from Yekson. He's told us a number of issues. At some point, you both mentioned liquidity at the same time. In your analysis, in your readings, in your writings, which you do very well, I must add, what do you see as the causes of some of these problems? What are, for you, what stands out as challenges in the microfinance institutions?
Well, before that, I want to address specifically certain things that he mentioned about, we have to look at this from two perspectives. At the granular level, which is his perspective, then we have to look at it from a systemic perspective as well. That's how we can appreciate the enormity of the problems. He mentioned that during the on-site review, there were questions raised about liquidity. And the BOG gave directives about not opening additional branches, not paying directors.
That was a report.
That was a report, the on-site review report. Yes, okay. Yes. Well, what I wanted to say is that that's a standard in the BOG regulatory playbook. If you read the business rules and sanctions for MFIs, Rule 35 sub 6 specifically, it indicates that for Tier 2 and Tier 3, which is a deposit taking Tier 2 and Tier 3, they are non-deposit taking, but take investments from the public. That if you're unable to meet both the primary reserve ratio, which is 10%, the secondary reserve ratio, which is 20%, and in some cases, special reserve ratio, which is 10%, aggregate of 40%. If you're unable to meet all of these reserve requirements, BOG will prescribe penalty for you. And in addition to the penalty, they'll provide these directives. Don't open additional branches, don't collect any more deposits, and so on and so forth. So I am conjecturing that perhaps BOG found a basis for concluding that maybe there were some violations of liquidity reserve requirement. In his case, I don't know that for a fact. As I indicated, the difficulty we have in all of these is that there's paucity of information from the regulator in terms of specifics, as we had at the banking level. Over time, I'm sure it will come. Until we have that, we can only use the framework, the regulatory framework as the rule, and then make a conjecture as to what may have happened. Let's go to the broader issues. I mentioned before that there's the framework I call the PTA framework, the prudential thresholds, the transaction limits, the asset liability structure. The prudential thresholds are what I indicated, the capital adequacy, liquidity, the gearing, and so on and so forth. The transaction limits, those ones are also very key. It's one of the reasons why sometimes it fits into the poor risk management practices areas. The Rule 41 of the business rules, it states specifically that no MFI shall give any loan to any single party, which is more than 5% of your net own funds, subject to a maximum of 10,000 for unsecured exposures What it means is that if I give you a loan, that loan, if that loan has no collateral, that loan cannot be more than 5% of my net own funds, my capital.
That's what you brought into the business.
Exactly. Conversely, if the loan is secured, then the amount cannot be more than 10% of my net own funds, subject to a maximum cap of 20,000. This is a difficulty in the microfinance area. There's no doubt about that, because there are situations where sometimes people deploy capital in excess of the 20,000 limit. So sometimes if you're what we call the single obligor limit or single counterparty exposures, if you're exposed in that manner and there's an economic downturn, it stress tests your balance sheets and things begins to start going bad. So it's a difficulty in that area. The asset liability structure. In the licensing regime for MFIs, Tier 2, Tier 3, Tier 4, one of the guidelines that the regulator specifies very clearly is that your minimum paid up capital, especially for the Tier 2, it's 2 million. Not more than 25% of that has to be in PPE, property, plant, and equipment. At least 75% has to be in cash and cash equivalents. So you have to be liquid resources to support your operations. Historically, what we have seen is the converse, because the business model that pertains in that sector is that there's a lot of confusion in terms of people confuse visibility for viability. So they invest in more brand assets, buildings, cars, and so on and so forth.
It's one of the courses Bank of Ghana has used for, for the current problems.
And in fact, this view is supported in empirical literature. I chanced upon one paper that was published in International Journal of African Development. Incidentally, one of the researchers was a Bank of Ghana staff, one Stephen Notte, I think. And they examined 4 microfinance institutions that collapsed in Ashanti region in 2014. They interviewed staff of OF, ISD, staff of GAMFIN, and the former staff of all of these microfinance institutions. The conclusion that they draw, there were 4 internal factors and 2 external factors that drove the collapse of microfinance. And it's supported in empirical literature globally. All of the internal factors are under this PTA framework that I talked about. Management issues, risk management issues, unnecessary branching. In fact, there was one microfinance started, I think, 2000, and within 4 years had opened branches about 22 branches within 4 years. That's basically about 5 branches in a year, or 1 branch per quarter. That's a rapid growth. So there's every little temptation. With all of that growth, there's the temptation that you dip into your deposit liabilities to fund the growth in PPEs. Then it begins to start generating asset liability mismatch. So you have short-term deposit liabilities, and now you have them trapped in non-current assets. So that's a difficulty. That's one of the things that causes collapse in the microfinance sector. The business model sometimes is not right because people do not adhere to the principles about the regulator has laid down. Don't invest more than 25% of your paid up capital in property, plant, and equipment. Keep a lot of it more in liquid form so you can support your operations. If we begin to look at all of these areas, I think in the long run, we'll begin to lower some of the risk in the microfinance sector. One more thing I want to mention under the poor risk management area. One of the things that I think is a game changer in terms of the credit risk environment is a credit reporting system. I've had a lot of analysis. I think not enough emphasis has been placed on the credit report system. As an MFI, Tier 2, Tier 3, Tier 4 banking sector, a financial institution, there are 2 interfaces that we have with the credit bureaus. Act 726, which is a credit reporting act. Yes. Section 24, sub 3 requires that on a monthly basis, within 72 hours of booking a loan with the client, you have to submit returns to the credit bureaus. That's a must. Section 26, Section 4 also requires that before you even book a loan, you have to do a credit search to make sure that that borrower hasn't borrowed from different. And that's one of the problems that we have in our sector because of the kind of demographic that we serve. There's a lot of, the phenomenon is called double dip. There's a lot of multiple borrowing. They borrow from here, they borrow from here. In fact, I reviewed one literature that says that in Nicaragua, there was one man who had borrowed from 19 microfinance organizations to the tune of $600,000.
That's a lot.
That's how serious it is. So as far as I'm concerned, the credit reporting system, the credit bureau system is an important game changer that I think if stakeholders take it seriously, it can transform the credit risk environment. The criticism has been that when you query it, you don't get responses. You get 0 hit, which in a sense belies a misunderstanding of how the system works. Because the system is a repository. So you submit data and you query data.
But we hear some of the banks and institutions don't want to submit because it gives access to people's clients and it cuts down competition.
No, but see, that's the thing, that's where I fault the regulator. Because if you read section 27, subsection B, the regulator has the power to exact sanctions for not submitting returns and not for doing credit checks. So if the regulator had been very serious about encouraging the adoption of the credit reporting system, I think a lot of the double dipping and double borrowing, it will be tampered down. That's my view.
Okay.
So I think that the credit reporting system is an area that we really need to look at. We have to look at as practitioners, because this is one of the reasons why I say culpability goes around the table.
Okay.
Because as practitioners, you're supposed to utilize that credit infrastructure to improve the environment. As a regulator, you're supposed to enforce sanctions when we don't. And the customers you don't do double borrowing. Okay. And if you do, we'll catch you. So in my view, I think it's one of the areas that we don't do.
We need to look at.
We really need to look at.
Carefully.
We need to look at.
Jackson, before I come to you, I want us to take a look at something my colleagues put together, Bismarck and Alberta. They went into town and they spoke to women who actually borrow from institutions like yours and in Kunims. Let's listen to what exactly they have to say with the recent goings on in the microfinance industry. So let's take a look at that.
Most of them take people's money, and you go there later on and you don't get your money. You want your money back, and they'll tell you go and come some other time. Meanwhile, you need the money urgently to do your business or move on with something else. Yeah, so I think they stepped in the right direction. If they strategize things well, and we see that we have good microfinance companies in the system, why not? And their interest rates are also good. Why not?
I'm not interested in saving in other small banks or little banks. Yeah. Those little banks that are not serious, I think they have to collapse that one, and we should deal with those banks that are serious. Because you'll be working and saving, and by the time you need money, you go to the bank and they'll tell you a different story. Yeah, it's too bad.
Say the Bank of Ghana, it's if a close microphone at once, and also me feel say, and it was sanka, yes, no boko, because a binima for swear monkwa, a binimum mansusun to me quenim because of Sasikano, because Odin kakran or day to her, and as I say, Abanasa, or because that hospital, Nisike, I was say ye be. Naya de Sunny are rare. What should no
Ebinu mo ho omo ye nti omo a me first omo de omo ho be kwa akoka aban ho na omo ne omo aye adwuma no me first no yesen omo a omo ehye ntokuru mu asie wo omo ho ukwaje bosia no kra na o default a interest that's one na penalty na that's one nya asam keto a ese ama ye gidi a ye wo mu no ekofom because suro bi abam suro na abam ne sese ye hu se omo akọ register adwuma na sell woman ne aban aka bomu na ebe ye adwuma na ye ntuma nkyere nti obi bakra na obeka eho asam kyere wa wonnim na usuro se wona ne be ye adwuma.
So you heard it there, some mixed reactions from a section of traders, female traders right here in Accra, and put together by my colleague Bismarck Ewusa as he went around engaging this, and he told me a lot, and you realize that some are for what's going on, some are against what is going on. But you heard the lady in the second video, the second lady in the video, she says we should close down the small ones because they don't offer any value. And I think, even though it's a very serious issue, on the lighter side, that brought some humor to the table. I would ask of Jackson, because he's the one who's been dealing with them, and share with us, Jackson, how you go around such barriers, if I can call them that. Just something small for us. How do you work around it?
Yeah, thank you very much, Philip. It is also a very good question. And I will definitely make sure I answer you. You see, looking at what the market women just said, one way or the other, they are right. I think they exist because of us, and we also exist because of them. But the question is, who do we really give our money to? They are the same people. When they do their business and bring money on board, deposit funds with us. The question, how do we also manage it? We return the money back to the same client. If not a similar client, maybe the alternatives one. But why is it that MFIs are not able to respond when it comes for payment? For my personal analysis, a lot of factors come to play, both even technical from the regulator and the institution, I mean the MFIs, and then also other industry players as well. You sit in your office, a gentleman walks to your office with a whole lot of stomach, pen and paper, and apply for credit facility, either a woman or a man. You do your homework well, as far as corporate governance is concerned, do your appraisals, and you realize that this person is fit to take the fund. Luckily enough, some of them have bank checkbooks. We rely on the bank checkbooks, give them fund. They also give us a checkbook in the form of a mode of paying back to us. But the problem is, if you come to some of us, our institution, you see the number of checkbooks that are lying in our drawers, you run away. And checkbook in law is a negotiable instrument. You send the same checkbook to the bank is even afraid to stamp it because he doesn't want to lose that very client because the account will be charged. When you take a Dutch check to court, lawyers also have their own definition on the same Dutch checks. The question, how then do you get this money and pay the depositors? It is because of this reason. Some of us, when we sat down for our own sober reflection, we have distanced ourselves from them. You don't want your money, your investments, your saving, and nothing. But this is what we have for you, if you can take it. So one, if Bank of Ghana can put policies in place to ensure checkbooks that have been given out in a form of paying back to us will be well monitored, I think the default rates will also come down. When it comes to loan payments, you'll be surprised that clients who deposit fund with you are not ready to pay the same fund back to you. So all that they are saying, although they are right, they also contributed to the development of this issue.
And I think it goes back to what's in Kunim sense, that culpability
Goes around the table.
It goes around the table.
Yes.
Everyone is involved. But one thing keeps coming up in this microfinance debate, or as I call it, the microfinance mystery. And I don't think the BOG and practitioners themselves have hammered on it. I don't know what you guys think about it. The concept of mission drift. I believe most of you veered off what you were supposed to do, helping the low-income earners, the market women like we saw in the video. Most of the institutions ended up funding activities of people that should be able to go to a bank and fund these activities. But because of the processes involved in running or accessing a loan from a bank, mainstream bank, they decided to come to MFIs because there are less credit appraisal processes there. Is that an argument that you would buy? I want to hear from Nkunim on that. Is that an argument that you buy?
I'm not too sure what the, but in my view, the issue of mission drift, there's some legitimacy to that argument, but you can't tar everybody with the same brush.
Okay.
I mean, by and large, the whole concept of microfinance started as being targeted to the kinds of demographics that do not have, I mean, the informal sector. So microfinance has developed tools and processes to deal with the uncertainties that comes with informality. Over time, the risk associated with that informality has also escalated. I talked about multiple borrowing. That's a big problem in the informal sector. You know, and when it comes to the credit appraisal process, you know, one of the things, there are about 5 or 6 chains in the credit management process. The application, KYC and verification, your appraisal, you disburse, you monitor, you recover if there's any, you do delinquency management and so on and so forth.
Nkunim,
yes.
Hold on to your horses for me. We'll take a quick break. When we get back, you will continue that for us.
Right.
This is the business edition of PM Express. My name is Philip Nanfuri, and my guest Nkunim Asante-Antwi and Yaxin Emmanuel Kuglenu. We're taking a quick break. We'll be right back. Right, welcome back. Somewhere in the show, I spoke about a notice from Bank of Ghana that contained Yaxin's company somewhere in 2018. This was a notice from the Bank of Ghana, and we've got a notice for you just to show you that about a year ago, his company was in good standing, and just after that, he's now in the gutters, if I can say so. So if you see there, number 283, Yakin, in blue, that's the highlighted one, Yakin Microfinance Limited. At that time, it was released in March 2018. He was active. He's considered a microfinance tier 2, Greater Accra region, and he's located on the Spintex Road. So this was Yaxin's company somewhere at the end of December 2017 into the new year of 2018 at that time. And he was active, according to the Bank of Ghana. Just a year down the road, he's been blasted, if I can say so. So I'm going to take concluding statements from you first, Nkunim Dini. Just tell us, you're wrapping up on something, and then just give us your last take in a minute.
So I was responding to the question about the mission drift. I think to the extent that a lot of the informal sector workers, particularly those in the, you know, agro processing, the market women traders, to the extent that they rely on the microfinance sector for capital, I think the MFI sector is still relevant. To the extent that a lot are deploying capital in the excess of 20,000 that ought to go to the banking sector, that's a mission drift area. But as far as I'm concerned, the MFI is still critical when it comes to achieving the SDG goals on poverty by 2030. My concluding remarks, I really sympathize with I empathize with my brother, because this is difficult. I mean, having built a company over years and all of a sudden your license is revoked, I mean, it's very disconcerting. BOG, I think we need to give BOG the benefit of the doubt as the regulator. They have great expectation that confidence will come back into the market. We can fault them on the processes. I mean, clearly, some of the ways that the things were done, it could have been done better. And I'm sure they would admit this on their part. So in terms of form, we can have our argument and quarrels with BOG, but in terms of substance, I think that the decision to clean the financial sector and make sure there's confidence in the financial sector, I think it's a policy in the right direction.
Okay. Yaxin, final comments from you. What do you want to tell the regulator? What do you want to tell us out there? What's next for you?
That's correct. What I want to say in these circumstances is that, first of all, it is my pleading to the market women and men, our customers out there, to access patients, for those who are also acting now, because it is not an easy thing. They shouldn't be rushing for a withdrawal, causing panic withdrawal here and there. I think it really affects the other institutions as well. They should just access patients and they will get their money. And then two, my next position goes to the BOG itself. It is my prayer that the BOG recognize the amount of money that they have incorporated to train some of us. I can tell you for facts that when some of us have our first degree in our LLB and LLM or whatever, the financial discipline wasn't there as it is today. And the BOG has taken that position to train some of us. And I think we are great assets to these states.
So, would you be pursuing any action furthermore? Just do that for me in 10 seconds.
For now, I cannot make any complaint or make any comments on that because I'm not independent now. I have other directors as well. Okay. And then we have to see them and see the way forward.
Okay.
Yes.
Okay. So this has been the business edition of PM Express. My name is Philip Nanfuri, and my guest, Yaxin Emmanuel Kublenu. He is the owner of a defunct microfinance institution, and Nkunimdini Asante Entry, Director, Yield Rock Services. I pray this has been a very fruitful and interesting discussion for you, as it has been for me. Have a good evening.